Hello and welcome to this week's live weekly trade plan, where we go through the financial markets and we look to identify weekly and monthly levels of support and resistance that we're going to be looking to use in the trading week ahead. But just before we begin this webinar, I would like to present a very exciting opportunity to you personally. So the Live Trade Room has been set up to offer traders comprehensive trading education, but most importantly, daily mentorship. So our traders can join us for 1 hour per day where we analyze the financial markets, we look to identify trading opportunities, and you can observe us trade our own live trading account. So the idea behind this is that you'll be able to get full access to our trade details but most importantly, our trading performance. So I'm delighted to say that we are currently accepting applications for places on our Trainee Traders Programme. Now please do click on the link below if this is of interest to you, and you can find out exactly what's involved and what we're offering. Now for a limited time only, if you are successful in your application, we are going to be waiving the fees associated with a place on our trainee programme. So there is zero cost associated with a place, and there is no potential for upselling or anything of that kind at any point. So this is a genuine opportunity, however it is subject to normal terms and conditions. So what we are looking for is genuine traders that are genuinely interested in learning how to trade the financial markets. So if this is of interest to you, please do click on the link below, do submit the relevant form, and one of our traders will be in touch with you over the coming days. So for now, relax, enjoy the rest of this webinar, and we look forward to seeing you soon. Bye for now. Good evening, everyone, and a very, very warm welcome indeed to this week's live weekly trade plan. My name is Tim, and I'll be more than happy to take you through tonight's webinar. So just as a bit of an introduction, this webinar is all about multi-time frame analysis. Obviously, while the markets are closed, this gives us an opportunity to take stock of what's happening with regards to price, actually, and it enables us to plan for the week ahead. So what we do is we take a technical look at weekly and monthly time frames, and we look to identify the important kind of highs and lows and potentially genuine levels of support resistance that we can use for the training week ahead. So as always, we look and we specialize in observing the price of 15 liquid global markets, but also we will present occasionally some other markets. And also it's an opportunity for you guys as well to post any ideas you'd like for us to have a look at for you. So without further ado then, let us begin by just reviewing our risk warning. Please make sure that you're aware of the risks involved in trading the financial markets. So hopefully you'll have a quick opportunity to read our risk warning. Of course, trading the financial markets is inherently risky. However, we take a really disciplined approach to trading these markets, and so we really do risk management. We put risk management at the forefront of our trading style. Okay, so with that in mind, let's have a look at the importance of multi-time frame analysis. So we think it definitely has a significant role for a number of reasons. Firstly, it's so that you can see more clearly exactly what is happening to the market and who is genuinely in control. Now that's very, very useful because just to give you a bit of an analysis, basically over the 15 markets that we look at, 12 of those markets are still very much range bound in terms of they're working within previous weekly highs and lows, which is fine. You know, markets can consolidate like this. This is the patient side of our approach when we trade these markets. 3 of them are US indices, which are just defying all gravity and just keeps pushing higher week in, week out, and they have done for the last couple of years. So in fact, you can take that a lot further back to 2009. They've just been keep sort of progressing and moving higher. But now we're in this position of all-time highs, which makes those markets very, very difficult to trade. But the point being, when you look at daily time frames or even shorter term time frames, the markets can become very choppy and very frustrating to trade. And taking a step back, look at weekly and monthly levels can obviously give us an opportunity to see more clearly in terms of what's happening and who's potentially in control of that market. The second reason for looking at multi-time frame analysis is that the larger the time frame, the more important the genuine level of support resistance becomes. Very, very important as well to just have a handle in terms of what the bigger moves are. So it can show you the important levels where a market is likely to move towards as well. So it has multi benefits to it. Okay, so let's get straight into the charts then. Good evening, guys. It's great to have you on board again. So like I alluded to then, what you can see up on screen, and you'll see what I mean as we go through all the remaining markets, we're still within this kind of weekly or monthly range-bound trading activity, and it's a good example to show. And I just want to point out to you a couple of, sorry, let me slide this across. Apologies, guys. I do. Sorry about that. So that should be better now, hopefully. Good stuff. So I just want to point out to you, so we've got the weekly high of the 94.04, and we've got our structural lows around the 92.40. And you can see that last week's highs, were still very much maintained. So with that in mind, then I just want to just get my pen up so I can just identify, why these levels are quite useful. So we've obviously got a 94.04 level in here. So we look at this candlestick and we think, right, well, did we get a break above that level? And the reality is, yes, price broke, but it reversed back beneath that level. So therefore, that just puts a little question in our mind. Would we like to sell this candlestick? Ordinarily, yes, if we get a close above that level. But because the market has reversed to these previous highs, as you can see that level in there, it's effectively just a bit of price action that's just broken above that level and reversed relatively quickly. And then we saw a little bit of a sell-off in this market last week as well, as a reaction to the FOMC. So you do get tips, and you get to see these levels and see how they stack up, and they stack up on a very frequent level. And what these levels of support resistance allow us to do is to just take stock and try to work out what is happening in these markets. And so the reality is, for us on a short-term basis, is to be nice and patient and just wait for this. Now, from a fundamental perspective, we're not surprised by this sort of 2-day reversal of the major sell-off move. So really, our bias has been to the upside. We just suffered a bit of a fundamental reversal, basically off the back of the FOMC, and we've had that price action reversed almost completely. But we're still approaching a 94.04, and it still has the potential to provide a little bit more resistance, preventing prices from breaking higher. So actually, Monday and Tuesday will be quite interesting. Do we get a confirmed break of this level? In which case, we could contemplate looking very closely at this area and looking to take it up to 95.02. So we still have this structural bias to the upside, which is quite important to have. However, we do appreciate that it has the ability to create a little bit of a structure in this with this previous low, and this market, if it breaks beneath that, it would be effectively a structural reversal to the downside. So when you get these sideways moving markets, and we know, so we've spoken a lot over the last week about the liquidity basically coming out of the markets between now and the end of the year. So are we surprised we're sort of in this range-bound pattern? Not necessarily. And if you can think as well from an institutional perspective, who really focuses on risk exposure to the markets, after the major moves in the indices, and it'll be interesting to see in the performance of a lot of your big institutions in terms of how profitable they've been over the course of this year. So it'd be interesting to see. Obviously, we're really looking forward to 2018. But there's no surprise to really sort of see the bit of the energy or a bit of liquidity come out of these markets. It doesn't mean to say that there won't be a trade to take, but we just have to bear in mind the conditions, which are clearly kind of, well, they respond quite well to these levels. And this particular dollar index probably isn't the best of examples to kind of prove or to go through kind of what I'm saying. So what we still have this level intact, the 94.04, and so I'm just going for we're looking at it on a daily time frame. You can see on the weekly, just it's tried to sell off, and that has clearly failed as well. So you sort of looking at this particular chart, this market clearly topped out at $95, and we've had a pullback, and it's looking for all intents and purposes that we're going to get this continued move to the upside. So that is why we've got a low in the market followed by a higher low, and irrespective of the fundamental understanding basically from the Fed and then the price action, it doesn't necessarily mean that this market is not moving higher. And this is some of the benefits that potentially technical traders have over fundamental traders, because if they've interpreted that this isn't good news for the dollar, you could have fundamental traders looking to drive the dollar lower. But then from a technical perspective, you can get this sort of pullback, and it'll be interesting to see around this price in terms of, does it stack up, and does it actually then become a little bit of a roll to the downside. So we are in this sort of decision-making sort of period, and it's quite an important period. But for all intents and purposes, we wouldn't be awfully surprised over the next 2 weeks if price remained roughly in the same area, with potentially a little bit more of a bias look to the upside. So this is the dollar index. So all we're going to do is to just, and it's more for consistency purposes, just work with the new high, the 94.18 level. So 94. So not a huge amount to change. So a 14 pip increase is really how far this market has moved over the last week. Again, another market which is sort of operating within this range bound. There's a major sell-off last Wednesday on the back of the FOMC, and it was basically just a bit of a disappointment trade. So the FOMC, gave the impression to the market that there was going to be a nice stable 3-rate increase next year, which is what was already priced in. It's what the market was expecting. So if there was a statement which lent itself to the belief that there would be more than 3 increases, then we would have seen a nice explosive move in the dollar. But because it was just a bit of a disappointment to the market, dollar actually sold off quite a lot, even though they increased interest rates. And this is the difficult environment. Normally, an increase in interest rates is obviously very, very good for a currency. You can often see and experience a flow of capital into that particular currency. But every rate announcement this year for the dollar has resulted in a little bit of selling. So, and to show you that point as well, to just give you, a bit of a background, I'm sure many of you guys have been looking at the dollar in a variety of different contexts. But let me just take you back. So we're actually coming from a level of 1.04. The idea was this market would be down at parity, and that was the major call. And as you can see, from January onwards, right the way to the height in August, September time, so early September, we've begun to see this little sort of pullback, and that's what we're anticipating. But without a shadow of a doubt, the dollar obviously has sold off for the majority of this year, and we're just getting this sort of consolidation, this sideways moving price action. But we now actually have a directional bias for the dollar to strengthen. So we just need to see and wait whether that follows through across the board or not. So we could be in for an interesting 2018. Okay, so that is the euro dollar. So no major change there. Can I just change the level for consistency purposes? Yes, I can. So this is the weekly low. So the low of this market is 1717. So again, so this is this time at 12. So this price has moved 12 pips below last week's low. So for all intents and purposes, with the volume of these markets and the amount of capital that flows through these markets, these are minuscule changes. The pound dollar has been an interesting market. Let me take you straight over to the weekly. So we're getting close to our ascending line. Price hasn't quite made it to that level just yet. That has the ability to provide, and I suppose there's probably an argument to this level probably isn't as accurate as it probably could or should be. So that's the kind of level that we'd be looking to work with, give or take. And these levels and these lines don't need to be, totally accurate, but they're areas in which, price is likely to react around. So that is the important part of these levels. Sorry, let me. Okay. And what you're doing when you're working with these levels is you want to see where is the area in which this market reacts the most. So we can see a number of interactions with these levels as this market moves to the upside. And we're just getting close to that level. So when we're looking at the 32.25, like you can see up on screen, is it likely to provide resistance? Well, from a technical analysis perspective, this market is very much likely to move to that way. But there is a very strong period of resistance. So we ask ourselves, would we be looking for a little bit of a pullback at that point? The answer is yes, from a technical perspective, unless we get a complete flush through, in which case, this ascending line can actually become resistance, preventing prices from breaking back above it. So this is the beauty about technical analysis and trying to interpret exactly what the likelier moves are. So we're going to have this market. This is a weekly time frame. So again, looking at the daily chart, this level is really stacking up. The weekly level. We've had 4 attempts last week to break beneath this level, and they all failed. Now you'd have to agree that there is from Friday's price action. And it was a market we were looking to sell. We did discuss about the potential for a break beneath Thursday's daily low to constitute a nice sell. It was just what some of the trades we were taking in other markets. So we were just cherry picking a couple of other trades to focus on. But as you can see, this market flushed lower, but is still held up at that particular level of support, which is also our weekly level as well. So what we're going to do for consistency purposes, let's just go and see what's happening. So again, we would expect continuation over the next week, but perhaps with not much volume. But this market has the potential to squeeze down to the 32.25 area roughly. So we're just going to change the weekly low. So I'm going to take the 32.87. And I'm just going to edit the 87. So we're going to work with these highs, the 35.48 and the low of the 32.87. And that is the pound dollar. So again, another market which is, and when we see these levels sitting in here and we look at these candlesticks, we think, do they fill us with lots of enthusiasm to buy this market? The answer is no. So what we do is we try to be patient, and we think actually, there's every chance that this market could actually roll lower. But you know, we're kind of working with the bigger levels, which is the 114.50, and down at these levels again, the 109. So we're kind of looking to sell 114.50, or maybe buy if we get a break above it, or to buy the 109. So really these moves within these levels, and don't forget we're still within the weekly levels to the upside and to the downside, and you can see how well that this market is respecting those levels. And with the time of year, what we do is we put 2 and 2 together and we think, right, well, we're clearly in kind of this sideways moving price action, so we're not so eager to be jumping in and out. Okay, so the only level that needs to be changed is the weekly highs. So we'll take a note of the highs, 113.73. So 113.73. So those levels are to the upside. So again, very, very minimal change. Taking that over, you can see the levels to the upside, the 129.18 and the 126.22. So we do expect this market to start squeezing higher. We were in this market, but because of the sell-off on Wednesday, it was quite a pronounced sell-off. We had our levels in there at break even, but the market has rebounded off those levels. So we were a little bit overexposed on some of our dollar trades. So we made sure what we didn't want to do was to suffer any losses. So we sacrificed a little bit of potential profit in exchange for making sure that we're not in a situation where we risk any of our capital. Sometimes those moves work for you and sometimes they work against you. So we didn't expose any of our capital, but we were taken out in a couple of these dollar-related trades in terms of our profitable exit or our break-even exit as well. Were taken out in this sort of very volatile, very erratic kind of move. But we are looking now at the 129.18 because there's plenty of scope for this market to be squeezing higher. And in actual fact, this level now is a breakout of a consolidated market. So we really like those because when you get these markets moving sideways and eventually you get that breakout, you can often get a really nice explosive move to the upside in a market like this. So obviously it's been through this phase now since October. So we've been in this phase of moving sideways for quite a while. So the longer it moves sideways, potentially the more explosive it can become. Now, there's still every chance that this level here could provide more resistance to the upside and we could get a little bit of roll to the downside. So just a little bit of patience is just required until the market decides to act. Sorry, to just show you this market effectively on a weekly time frame. There's no changes required. You can see it's looking a little bit bullish there in recent price action. You'd probably, I mean, you have to bear in mind what's come before it. So we do have a couple of lower highs in this market. So it's a bit confusing, I guess. It's not as clear cut. So if you have a high in this market and this creates another high, then you've actually got, it's basically one of these markets that's become very bearish during that move, but now very bullish in this one. And then this market has bottomed out. So we actually have a low down here and a lower low. So it's a little bit confusing. It's not clear cut, but a break above this level here would constitute an interesting opportunity to buy this market once more. We think there's plenty of scope for this market to be squeezing higher in that one. So there's no change again that's needed for the dollar CAD. To give you a bit of a broader, taking a step back from the lows here in 2011, we had a lovely big bull run, and we've had this sort of pullback, but that's all we perceive it. So we think there's plenty of scope for this market to be squeezing higher once more. Okay, so the euro yen. So the euro yen again sideways moving. So that's the market conditions in which we're trading. So if we decide to trade this market, and we find it quite choppy, then we should expect that, because this is what we're seeing in the price action. So what it means is we can stay out of this market. We can allow this market to do whatever it wants. Maybe there's opportunities to sell if around these highs, and maybe there's opportunities to buy the market around these highs. But they're, from a conviction perspective, they're kind of medium to low conviction trades. You might be better off putting your capital in other trades. However, saying that, if we got a break below the 131.15 or a break above the 134.46, then those could be very, very interesting trades. Again, it's that principle of consolidated markets. And again, this has been consolidating for 4 months now, sort of back early September. We just trade what we see. We see the market moving sideways, and until we get a break below, looking to push this market lower, or we identify a nice opportunity to take it higher, we're going to let the market decide what it wants to do, and then we can plan and act accordingly. So again, just a little bit of patience. No need to be making any changes with regards to the weekly levels. And this is the same. This is what we find across all the markets, apart from our 3 major US indices. So this is the market that continues to surprise. Friday was another very, very bullish day again. So we're now at all-time highs. Really unbelievable moves. So what we're going to do then, we'll have a look at this on a weekly time frame. So this is the market that keeps on giving. So again, we're just going to, it's more for consistency basis reasons potentially. So 2682, 2682, and unless something structural changes in this market, there's and the US tax plan is potentially, could become a bit of a nail in the coffin as far as the US indices are concerned. So, and that's basically to both sides, whether they become more bullish or whether there is a pretty significant correction in this market. So it all just remains to be seen. So to the downside, we're going to take the 2649. 2649. So those are the levels to the upside and to the downside in this market. Yeah, sorry, Connor, I'm just reading your messages now. Apologies. What about if it went below? Could that be a sell opportunity? I apologize. It's probably the dollar CAD. Okay, great. So let's just go back a couple of markets. Yeah, so that is the beauty about kind of range-bound markets, is that, and it's obviously you get to see more price action in this time, is that the longer this market moves sideways, normally the more explosive the move becomes. So we just have to tolerate this particular bit of price action, and yeah, a break above. Let's buy it and let's run with it to the upside. A break below and let's run with it to the downside. So you're absolutely right, and the same applies for the Japanese yen as well. Okay, so yeah, due to the candle type, do we have a bias to the upside? Yes, we do. And we're just looking at what has come before us, basically, in the dollar CAD. So we've got to take on board this major sell, from these highs, 37.90, right the way down to 120. So a major devaluation in this market, largely to do with the decisions made by the Canadian central bankers. So we've had a major devaluation, and we've had a bit of a reversal of this recent major move to the downside. And so if you get a confirmed break above 29.18, it would constitute a pretty significant structural failure to the downside. Sorry, to the upside, meaning a trade to the downside is going to be off the table for a period of time, and then you're just looking for opportunities to buy this market. Okay, so the S&P, so we've already worked with those levels, so hopefully that was useful. Okay, so again, the Dow Jones just keeps squeezing higher, so let's look at it on a weekly. No point looking at them on the monthly levels. So what we have here is the high is 24,000. Wow, 24,000. Can't quite remember what the high was. 24,705. 24,705. Okay, and we'll work with the lows as well. So 24,319. So 24. So those levels are in there. The FTSE has been an interesting market, very much range bound. So we're working with these weekly and monthly highs and lows, 74, 72, and the 72, 76, and we're just back and forth within those levels. So you must admit, with a little bit of a bullish sort of bias to it, what's concerning about some of these markets is one high, two highs, followed by a low and a lower low. So, but you'd have to say that this market has been moving in one direction. It obviously reacts. It reacts to the movements of the British pound. So if the pound sells off, this market is moving higher. If the pound strengthens, then this market is moving lower, and it's literally as straightforward as that. So what's happening in the pound is a quite a strong indicator for the FTSE. Okay, and again, we're at all-time highs. So just historically, uncharted territories, in terms of these highs, how does price react around those? Normally, you get a lot of volatile price action. However, recent moves in the global indices can make you feel and think very, very differently than in actual fact. It's very stable to be trading these all-time highs, but that's a little bit more of a fairly recent phenomenon. You trade these recent highs in other markets, you can find them very, very choppy, very volatile, and so the FTSE, we're still within those levels on a weekly level, but you can see the potential for this market to actually squeeze higher. So we keep an eye very firmly on the British pound. Again, sort of the Nasdaq is off to the races, so you can see, a major move there on Friday as well. So let's have a look at that on the weekly time frame. So let's work with these levels. So to the upside, we're looking at 65.01, 65.01. Now, there's every, there is this really strong vibe out there that actually, the potential for a bit of a strong correction in some of these indices seems to be sort of coming off the table a little bit. There's plenty of scope for these markets to be squeezing higher and continue to move higher. And that for us is the beginning of alarm bells beginning to ring, because when there's an expectation for these markets to keep moving higher is probably when they're at their most dangerous. Whereas what we've been seeing is, and we're talking about sentiment here, we're talking about market psychology. So it's not so much what you and me think, it's more about the psychology of the actual market themselves. And what we found, and there's an irony to it, is that at every level, you're getting a lot of the sentiment in the market is literally looking at these levels and they're thinking, right, well, surely this market can't move any higher. But each time you're just getting that breakout to the upside time after time. And it's just defying a little bit of common sense because these markets keep pushing higher. But now there's the potential market psychology that actually now these markets can continue moving higher for as long as they want to, and there's a bit of a realization. And that's when we think that obviously what you're likely to see in situations like that is actually more trading, more volume coming into these markets. Yes, price is pushing higher, but the stability of the move starts to sort of unravel. So it's going to be fascinating to see what happens in 2018. Now, we're going to have an annual review at the beginning of January, and that's going to be a very, very interesting webinar. We look at each and every market. We'll review, what's happened over the last couple of years. We'll take stock of what is potentially likely to happen for the year ahead, and we'll monitor that as well throughout the year as well. So hopefully you guys can join us for that. So to the downside, we are looking at the low of this 63.39. So let's bring this level up, 63.39. 63.39. So those levels are in there. Another reason for monitoring these weekly lows in these markets is if we get a significant correction in these markets, then these weekly lows will be our first indication. So what we're likely to see is kind of structural failures, a lot of volume coming into these markets on a daily time frame, hopefully structural failures. That makes us sit up in our seat and say, right, well, there's potentially something happening here. We get a break beneath the weekly lows, the monthly lows. All of a sudden, it can be very easy to be quite aggressive to the downside if there's a lot of volatility coming into these markets, and all of these people, all of these traders that have been buying are suddenly seeing what we're seeing, and they start sort of taking profits, and all of a sudden you're adding a lot of volatility to the downside, and that is the potential for us to trade. But a lot needs to happen before we will ever get to that particular point. But that's just another sort of benefit to trading, these much larger levels. Okay, so the gold market next. We are a pretty significant rejection actually on Friday's candlestick. So it was looking very, very bullish, but bullish into these levels of resistance around the 1260 level, where we've seen a really nice clean cut rejection now. So a break beneath this daily low would actually constitute potentially a nice sell. So there might be an opportunity for us later on to increase our entry to beneath Friday's low rather than Thursday's low. So we'll have a look at this very, very closely when the market's open and see what happens to the opening price. From a multi-time frame analysis perspective, we've got quite a large bullish spinning top really here in this market. So it doesn't really tell us a lot unless we get a break above the weekly high. And again, so what we can do is we can edit these highs and lows just to so the 35.05 can absolutely be a level that we can work with to the upside and to the downside. So with that in mind, let's work with these levels. So to the downside, we are looking at 1236, which is exactly where we're at now, and to the upside, it is 1261. So 1261. I'll just edit this one here. 1261. So there you go. So that's the weekly high. And again, a break above that level and above the 1263, which is what we've got sitting above it. There could be an argument to say that this market is at a stage where it's continuing to look quite bullish again. So, we are potentially looking to sell this market just because of this kind of price action. you know, where we've, excuse me, sorry about the squiggly lines on the screen, but we're potentially looking for this market to start squeezing lower and potentially attacking these kinds of levels. And on the fundamental side as well, just regarding gold, that there is, you know, real potential for the price of gold to reduce. But what we need to take in mind is the market's bottomed out at, you know, $1,044, and also we've created this low, and we've created a couple of series of higher lows, and let's see if this level becomes one of those levels as well. So with that in mind, let us just zoom in a little bit, and I shall take off these levels. So we are looking for opportunities to sell this market, even though last week's candlestick was quite bullish. You can see the move since last week, but we think it's potentially a short-lived, potentially a market that has the potential to come down to sort of 12.20 or 12.15 level, somewhere around down here. So, and that's what we're looking to trade. So we've already taken that in our day trading room, sorry, our live trade room every evening. So that is okay for the time being. Why is this level just, oh yeah, it's because it's 71. So I might just change this level 0.71, which is nearly 12.62. So just two more markets then before I let you go for the evening. Crude oil. So again, we're working within this $59 and $55, $55.50 level, and you know, it's looking like it's coming off a little bit, and we just got a couple of strong days. So we're ultimately bullish this market. We would like this market, if possible, to kind of move lower, ironically, before moving higher. But we can only trade what we see. We ultimately think this market has the potential to squeeze up to $62, which would be in line with the technical analysis that you could see up on screen. It's just being patient and bearing in mind we're going into the festive period as well. So let's see if we get a break of these recent highs, the 59.02. If so, there could be interesting opportunities to take this higher once more. Okay, the 10-year note, just to finish. So sorry, I appreciate there's no changes to be made. Again, we're still working within our weekly highs and our weekly lows. The same for the gold market. We're working within roughly those same levels. And finally, the 10-year note. Now, there's an argument. In fact, we will actually proceed in doing that. There's an argument now we can bring down the high. So you can see how, let me zoom in here, and you can see how these levels of support work. The low of this market is 123.89, and our level there is 123.81. So you can see how and why these levels, you know, become levels of support and resistance. Resistance preventing prices moving higher, and support preventing prices from moving lower. So that's the principle of something that is supporting price in the market. Okay, so that's the weekly level. So what we're going to do is take last week's high of 124.69, and we'll now work with that to the upside. 124.69, and I'll put that level in there. So what we're saying is this market has the potential to obviously pull back and squeeze higher, and if it does, then potentially a trade above the 124.69, and we have the 124.77 just above it. So it's just we need to get a confirmed break of both of those levels, and there might be an opportunity to buy it. Although for a lot of the fundamentals with some of these bond markets, they definitely, a lot of them have the potential to be pushing lower, especially with the US indices at all-time highs. So that just about wraps it up for this evening, guys. And to just kind of let you know, really, that this is the last Sunday webinar for the year. The major reason for that is normally the amount of volatility in some of these markets is very, very low. So What we're likely to do is to discuss a lot of weekly highs and lows, being in exactly the same position. So we'll work with these levels now till the end of the year. It's not to say that there won't be opportunities to trade them. They very well may be. But what we will do is we will post, thoughts, considerations, trades in our, private traders Facebook page. So you can hopefully see those and you'll be updated on those as well through Facebook. So what we'll do tomorrow evening is, if there's any of you that would like to join us through our Facebook page and still haven't registered yet, because I know there is quite a few of you actually that are still in the, that could do with still joining our Facebook page, then please jump on and let us know. And tomorrow we'll give you the opportunity to do that in our live trade room. So so these are our social media platforms, public ones, and any questions, guys, I'm more than happy to take them from you. You're very welcome to post them in the chat box. If you need to shoot off, I appreciate some of you join us on and off for the daily trade rooms, and some of you adopt the Sunday webinars as well for a little bit more sort of long-term approach. So whatever your circumstances are, if we don't get to speak to you again, we will have this week of the live trade room, and then we'll be effectively closing down for a week or so, and then we'll be firing up again on the 2nd. We're going to do an annual review on the 2nd of January, and then we'll start our live trade rooms as normal from the 3rd of January. So if we don't get an opportunity to wish you Merry Christmas, then we do hope you enjoy the festive period, and we do look forward to seeing you hopefully come back and join us on a regular basis again in the new year. So an exciting 2018 in the pipeline, hopefully. Okay, so just looking through the comments, guys. Thanks very much. I wish you Merry Christmas as well. I suppose to sort of give you a little bit of a review, the first 6 months of the year from a trading perspective produced some really interesting opportunities. The last 6 months of the year, not so much. So we have to trade the market conditions, and but that is I suppose the realities for financial traders. Unless you were trading those US indices, which obviously were the trades of the year, that and obviously some of your cryptocurrencies, and I appreciate a few of you trade those as well. They're just very speculative, very, very volatile. You're getting 20-30% pullbacks, within a day or two. So just not particularly stable enough for us to be trading those, in a public forum, just because it's craziness. It's crazy moves to the upside and crazy moves to the downside. So we'll leave those that would prefer to speculate on those, and we'll leave it to them. Okay, so look, it doesn't seem like there's any significant comments. So so on that note, thank you very much for joining us. If we don't see you again, have a fantastic Christmas, and we wish you all the best for 2018. So look, for those of you that don't perhaps know, this webinar has been recorded and it will be placed in your members area normally within the next hour or two. So it's all there in your members area for you. So on that note, thank you very much for joining us. Do take care. And those of you that can join us for the week in our live trade room, please do. And we shall see you during the week. Everyone else, happy Christmas, and we look forward to seeing you in January. From everyone here, take care and bye for now.